to give their clients and customers access to more ETFs, more mutual funds. I think they have 4 or 5 big partners right now, like Wells Fargo and is it JP Morgan? I can't remember. But some pretty recognizable names. I'm sure they'll keep building out. Aberdeen is one of them. So they'll keep building out the wealth management business, I'm sure. I'm actually supposed to interview the CFO of Futu either next week or the week after. The company did a stock offering about a month ago, raised about $1.4 billion. They're going to use that cash to expand their products and services, expand their margin capabilities, and then expand internationally. They said that they're seeing a lot of growth right now in Singapore and the U.S. And I know they want to push, harder into these other geographic areas and not depend so much on just Hong Kong and mainland China. So I'm still very bullish on Futu. I mean, I'm expecting the company's growth to obviously slow down as we get through the year. We run into slightly harder comparisons or comps over 2020 numbers. I still think the company has a very good shot of doing, about 180% year-over-year growth. I think net income growth I'm expecting is about 240% year-over-year. The company is now trading, if you back out that cash, I mean, this is as of a couple of days ago when my write-up went out, but you had a market cap of, let me just double check the numbers so I don't screw it up. So when this report went out on Monday, market cap was about 18.2 billion. Enterprise value was about 16.8 billion. If you back out, so then divide that by, my revenue projections for this year, which are like 1.2 billion, and the stock was trading at, I want to say like 12 times this year's sales and under 30 times earnings, which is just ridiculously cheap for a company that's growing at 180% top line, bottom line 240%, and they increased their net income margins this quarter up to 52%. I don't know if that's sustainable or not, but either way, I think by the end of the year, they should be in that 50% range. So I'm expecting them this year to do probably 1.2 billion top line, 600 million bottom line. I just think this is a $200 or $250 stock by the end of this year. It started running today a little bit. It was like, let's see, right around maybe like an hour ago, it jumped from about 135 up to 140, almost 140. So, maybe there's some buyers coming in. So this is my biggest position right now. The other stock, I'm trying to think what else I can talk about with Futu.
Who are their main competitors?
So, I mean, there's a few competitors in China. I mean, the one that everyone likes to compare them to, and I think a lot of FinTwit owns this stock as well, is Tiger. Well, I think we all call it Tiger. I mean, technically the company's name is I think it's Up Fintech, but the ticker symbol is TIGR. So if you look at the two at like a quick glance, Tiger looks cheaper on a price to sales multiple, but that's kind of a misconception, because if you start to dig into the numbers and you actually look at gross profit, operating income, net income, etc., Futu is much cheaper on a valuation basis. Plus, Futu is actually growing faster than Tiger is. So they have a much stronger brand over in China from people that I talk to, and they have a much stronger balance sheet as well. So, and they obviously have, or maybe not obviously, because some people don't know this, Tencent is actually their largest institutional shareholder. Tencent was an early investor in the company, along with some other big VCs that people are probably familiar with, like Sequoia and General Atlantic and Matrix Partners. I believe each of those VCs still have a board seat. The company, I know some people don't trust the numbers necessarily, but they do use PricewaterhouseCoopers as their auditing firm. And I think one reason that the stock started to rip the last 24 hours or so is I think some people didn't believe that numbers for Futu could actually look this good. I mean, there really is no other company on the planet that's growing revenues this fast while maintaining profitability. But I mean, the total addressable market in Asia, obviously, for the younger generation to get more into trading and wealth management, and Futu's already announced that they're going to be rolling out crypto trading and services later this year. So, who knows where that might go. I don't think they're going to be able to. I don't think mainland China residents are going to be able to tap into those crypto services, but I think Hong Kong residents, and then almost definitely people in Singapore and any other regions they expand into, will be able to use those crypto services. So I'm excited about that. I'm not a big crypto fan personally, but I think platforms like Futu can obviously generate a lot of revenues and fees off of crypto. Okay, so that's Futu. I mean, so let's be honest, it is a Chinese company based in Hong Kong, so that is a risk. But, I said in my write-up, if this was a US-based company generating these sorts of revenues, this kind of growth, these sorts of margins, this, 600 million in net income, I mean, you would not have a US company with these metrics trading at under 30 times, enterprise value divided by sales. I mean, you would have this company trading at, or let's just use PE, price over earnings, because that's one that people are, valuation metric that people are more familiar with. So basically market cap divided by revenues is your PE multiple. So the PE multiple on this, if you don't back out the cash, I think is, I don't know, let's call it 35, somewhere in the mid 30s probably. If this was a US based company with these sorts of numbers, I mean, the stock would be trading at 90 or 100 or 120 times earnings. And I'm not even joking. I mean, there are plenty of mature growth companies in the US that are growing at 30% and trading at 50, 60, 70 times earnings. I'm not going to rattle any off right now because I'd have to go double check the numbers, but I assure you there's plenty of them. So a company like Futu based in the US with these numbers, if you take 600 million in earnings for what I'm expecting and throw on 100 PE multiple, which would be justified, for a company growing revenues 180% and net income at 240%, 100 times earnings would not be outlandish. I mean, you'd have a 60 billion market cap company. So, I mean, right now, I think there's like a 60 or 70% discount on Futu because it's from China. And I think there should be a discount, that is a potential risk. I don't think 60 or 70% makes any sense. I think 30 or 40% is probably more appropriate. So I think there's a good chance that Futu is probably 40 to 50% undervalued right now, which is why I think this is a, $200 to $250 stock by the end of this year. But, we'll see. Next stock. So this is one I've definitely talked about before. Most people are probably familiar with it. It's starting to rally pretty nice the last couple of days, which I'm obviously happy about. That's DermTech. So this is the company I did a write-up back in January. The stock was at, I want to say mid 30s or high 30s at the time. It rallied all the way up to 84 within probably 6 weeks. Crazy. I mean, I didn't sell any because I was promoting the stock through Substack. I didn't want to be that jackass that was, I'll use the word pumping, not that I was trying to pump it at all, but I was definitely recommending the stock to people, in my Substack and then on Twitter. Now, I wasn't adding to it. I didn't tell a single person that I was adding in the 60s or 70s. Other people were buying it. Maybe it was big funds. I have no idea. But the stock really got ahead of itself up into the 80s. And then when we saw these, all these growth stocks, these high growth stocks that are unprofitable start to pull back, obviously DermTech came down with it. Stock pulled all the way back to, I think it was like 28.5 a few weeks ago. So, I mean, once again, I kind of doubled down on the stock at that point, and now it's had a nice rally up to 40. I posted an interview yesterday with Rajiv. So he's the sponsor behind the SPAC that actually took DermTech public last year. Really, really smart guy. He had some very nice things to say about DermTech on the interview with Benzinga. Technically, it was an interview for his other SPAC, which is AHAC, which is taking Humacyte, which is a North Carolina-based company, taking them public. They basically grow artificial veins and stuff like in glass jars. I mean, it's pretty wild. They have a lot of different products, and they're going through trials with a lot of them. But I mean, that company could have massive upside. So that's a stock that I'm watching pretty closely. I think once they finally get through this SPAC merger, de-SPAC, and start trading under their own ticker, that's the kind of company that would probably take a position in. It's just too early right now. I just think the SPACs are all crap until they de-SPAC. So, but that's one that's on my watch list. But back to DermTech, and Rajiv said he thinks DermTech is $100 stock in the not too distant future, and I would agree. Now, when it gets to 100, I have no idea. I doubt it gets back to 100 this year, or not back to, but I doubt it gets to 100 this year. Maybe end of next year, this could be $100 stock. I could see that possible because of what the company has coming up in terms of their pipeline. So the product that we're all very familiar with DermTech right now is their genomics PLA, or PLA and PLA plus patch. So PLA stands for pigmented lesion assay, and that's the patch that's the size of the quarter that you're rubbing over your mole and then shipping it back to DermTech. They're analyzing it and looking for any indicators of melanoma, which is very, very exciting because a lot of people die from melanoma. It's the most aggressive and the most deadly form of skin cancer. The other two are basal and squamous cell, and DermTech has products coming out for those two cancers early next year, so 2022, and then in between now and then, we're going to get the launch of Luminate, which is their UV or their skin analysis product that will help determine how much damage has been done to your skin, primarily from the sun or UV.
I'm assuming all these products are approved by like the regulatory agencies and all these things.
Yes, you don't need FDA approval because these are clinical products. So you don't
have they been peer reviewed, like someone else?
Oh yeah. Yep. Yeah, I mean, so that's sort of the route they take. If a product doesn't have to go through the FDA, and get their stamp of approval, then you're going to want to do, like you said, peer reviews. So, there's tons of peer reviews out. The NCCN, which is the National Comprehensive Cancer Network, which provides a lot of the guidelines for cancer institutes, oncology professionals. They've basically given it their stamp of approval, which is a pretty big deal, which is kind of how they popped up on the radar a few weeks ago when DermTech, so Cigna, which is a big health insurance company, changed their guidelines where it looked like they were going to start to support DermTech. And this, I sent out a tweet because that's the impression I got. And from a couple analysts that I talked to, that's the impression they got. One of the analysts, I think it was from Craig Hallam, actually came out and put out a report saying this is massive news for DermTech to have Cigna support. It turns out that it was kind of a jump of the gun, that Cigna did change their guidelines, but it didn't necessarily mean they were supporting DermTech yet. However, on the most recent Q1 earnings call, Dr. Dobak, or John Dobak, the CEO of DermTech, did say that they are deep in discussions with Cigna, as well as many other large commercial payers, fancy word for health insurance companies. So we could see some big announcements in the near future. Blue Cross Blue Shield of Michigan, or no, not Michigan, Illinois, California, and Texas are already out with their support for DermTech, but there's like 31 or 32 other Blue Cross Blue Shield organizations that are all part of this federation. So, we could see announcements from any of those other Blue Cross Blue Shield. So, I mean, there's a lot of catalysts on the horizon for DermTech, between insurance, between the product launches. They really did beef up their sales team pretty heavily over the last year, so that once the pandemic is over and their sales reps can get out to the dermatologists and present, this PLA product, the PLA patch or sticker, we should start to see even more and more adoption, from the dermatologist community in the coming quarters. When you look at the Q1 results for DermTech, I mean, the number that you really want to pay attention to is, so there's a couple numbers in there. It's, how many different dermatologists are referring patients, for the patch. That's a big number to pay attention to. That was up pretty big. But then the other one is the the SA revenue, and that was up. I just want to double check the number. So SA revenue was up 170% year over year, 40% quarter over quarter. That's the big number, because that's coming from the PLA patches. So that's why the stock has reacted so well over since they reported Q1 numbers. It's that number. It's the 175 quarter over quarter and 175 year over year and 40% quarter over quarter. So I'm still. Oh, I'm just double reading through my Substack right now. So there's 36 different Blue Cross Blue Shield organizations representing 106 million Americans. So, and okay, so that wraps up DermTech. I'm just going through like my largest positions, because I'll just rattle off my top 5 or 6 positions. So Futu is my largest. Upstart is second largest. It was my largest up until a week ago, but I did a lot of trimming. DermTech is 3. Celsius is 4. So I did talk a lot about Celsius yesterday on that interview that I did. I did a Twitter thread a couple days ago, or maybe it was even yesterday morning, about Celsius. Even though the stock has had a really nice run this year in the past month, I still think it goes much higher, and I'll just break it down real quick in case no one saw that thread. So here are the numbers, and I'm not making this stuff up. These are like reported numbers that you can go look up anywhere you want. Nielsen, which tracks scan data, was reporting about 100% year-over-year growth for Q1 2021 over Q1 2020. This is for Celsius, and this is for US. And then when Celsius actually reported their Q1 numbers, they reported US operations were up 101% year over year. So, you can just, it doesn't take a rocket scientist to draw a line between US operations revenue growth and what the Nielsen data was tracking for. Now, fast forward to Q2. Now, obviously, we're only 7 weeks or 8 weeks into Q2, but we've already seen the Nielsen data for April, which obviously that's part of Q2, and that was up 200% year over year. And I don't think May is going to be that much slower, but I did, even in the thread that I posted yesterday, I said, okay, hypothetically, let's say that April was 200% year over year, May was 180%, and June was 160%. So you basically had an average of 180 for the quarter. If that's your US operations number for Q2 over year, I think there's a chance that that Celsius ends up doing 130 or 140% year over year. Now, the only thing that's going to slow them down, in my opinion, they're increasing their store count, they're increasing the number of DSD partners, they're increasing how many of these branded coolers they have rolled out. They're number 2 on Amazon, right behind Monster. So they're doing everything right. The only thing that's going to potentially slow them down is this stupid freaking aluminum can shortage. So I don't know if this is because so many people are not drinking in bars and restaurants anymore, and they're only drinking at home. And if they're drinking at home, they're more likely to drink out of a can, a beer can, an energy drink can, a soda can, whatever. Like, I don't know how bad the shortage is. No one's going to, it's impossible for me to know exactly how bad it is. I just know that there's a chance that any beverage company that sells product in aluminum cans is going to take a little hit this year because of that, or this quarter because of this aluminum can shortage. Or they might, obviously when there's a shortage, prices typically go up. So you could see the aluminum can shortage not impact, the quantity of cans sold, but instead hurt the margins on each can. But we'll see. Either way, I think they're going to end up blowing away that 53 million number that the analysts are looking for. So now, whether or not that number comes up in the next 2 months, before they report, I have no idea. I just don't think it's too late to get into Celsius right now. They're doing everything right. They only have 1.2% market share. Red Bull and Monster are still dominating, and Celsius is doing a great job of catching them. So I didn't mean to go into that much detail on Celsius, but it is a big position of mine, so I wanted to mention it. The other one I'll just mention real quick before I jump into Desktop Metal is Itarian. This is the old Mohawk. I'm still bullish on the stock. The stock, I wrote about the company at $12 in December. It ran up to 48. It came right back down to 12. Now it's trading over 18 again. So it's been, like a lot of these other growth stocks, it's been a roller coaster year for a stock like Itarian. They did change the name from Mohawk. There was a short report, which was a bunch of bullshit. I mean, the company right now is still executing very, very well. I would like to see them get a bigger, cheaper credit facility. Their current credit facility is a little on the expensive side at about 8% plus warrants. If they can get and they've actually mentioned this before, so I'm not saying anything that's not already public information. They said this on the Q1 call. They're talking to some tier one banks about getting a bigger credit facility, maybe in the $200 million range. I'm making that number up myself, but that would be awesome because that would allow them to continue on this path of M&A. So what they're trying to do right now is there's 6 million, somewhere between 5 and 6 million FBA, which is fulfilled by Amazon. So there's 5 to 6 million FBA sellers, independent sellers on Amazon. And, companies like Itarian, and then there's some other ones out there like Thrasio, and there's a couple in Europe that just raised a couple $100 million each. They're all doing this roll-up strategy where, you acquire a company, or at least like in the case of Itarian, this is how they're doing it. So they're acquiring profitable companies. So this is accretive to earnings. Profitable companies at, let's say, 4 to 5 times earnings, and then they're stripping out 80% of the fixed costs. So when they buy a company for $20 million, they're basically saying, we're buying the revenues, we're buying the product, we're buying the IP, we're buying, your Amazon relationship, your supply chain, all of that. We don't care about anything else. We don't care about your people. We don't care about your office space. We don't care about your marketing expenses, because we're going to eliminate all of that. And we're going to make this a much, much, more efficient, more streamlined, more profitable company once we absorb it into Itarian. So that's how they're doing it. And it makes sense if they can keep doing it with cheap debt. So the deal that they just did for Squatty Potty, $19 million plus a bunch of other crap in there, took it up to about 28 million in total. Squatty Potty earns about 5 million in profits every year. I think Itarian can probably strip out close to $2 million, if not more, of those fixed costs when they get rid of all the people, and then office space and some other stuff. And now you're looking at a company that, instead of generating 5 million in profits, is going to generate at least 7 million in profits. You're looking at a 25% earnings yield off of that $28 million acquisition price. That makes a lot of sense when you can finance it with 5% debt. So those are the deals I want them to keep doing, as long as they can, as long as the debt, as long as they can access, cheaper credit. So that's Itarian. So I'm still bullish. I added to it a couple days ago when it dipped down back to like 16. Now it's back up almost to 19. So, but I did I trim? Yeah, I trimmed. I think I trimmed like 5% of my position today, around 1850. I'm just did a little trimming in my portfolio today. I mean, I'm back up 70% for the year. So I'm just trying to take some profits, be a little bit more prudent about taking profits when you get these big green days. So finally, Desktop Metal. So that's a stock. I think that was actually my last Substack write-up maybe a month ago. So I've known about this company for the last 6 years, I think it is, or 5 years, whenever they were started. A couple of my good friends were actually investors in their very first round of capital, when the valuation was probably like 20 or $30 million. So they've made a hell of a return on their investment. If you're going to, if you understand the potential of 3D printing, and I'm starting to, I believe Desktop Metal is going to be the leader years and years from now. So right now, they are not the largest player. I mean, there are other 3D printing companies that are already doing 300, 400 to $500 million of revenue, but that growth is slowing down. But Desktop Metal is going to catch them and surpass them. They have better machines, they have better materials, they have better IP, better investors, management team, strategic partners. Some of their big strategic investors that were investing while this was still a private company were GE and Ford and BMW and Koch Industries. And like, those are all the large manufacturers and OEMs. And that's who Desktop Metal is going to be selling their machines to. So, if you are a manufacturer of autos or planes or anything else. I mean, you are sourcing parts from many different vendors all over the world, and it's very expensive to ship parts all over the world. And then if it's coming from outside of the US, you have to deal with duties and tariffs and freight costs and product delays as product is sitting on ships out in the middle of the ocean because the ports are backed up. I mean, we saw all of that last year. A lot of supply chains got screwed up. How much easier and faster and cheaper would it be if these large manufacturers and OEMs had these machines on site where they could actually make these parts themselves? And that's essentially what Desktop Metal is allowing them to do now. And they can customize parts. They can make one part, or they can make thousands of parts. I believe what Desktop Metal has said in their presentation is that right now it is faster and cheaper to make parts in their machines up to 100,000 parts. Once you get over 100,000 parts, the cost benefit analysis no longer favors the 3D printing, or what they call additive manufacturing 2.0. It favors the old way of doing it, stamping, molds, etc. But Desktop Metal said that that's going to change over the next 5 years, and then that 100,000 will move up to about 500,000, and then by 2030 they expect it to be about 1 million. And that's when people like Cathie Wood and Chamath and Bill Miller, who's actually one of the best investors over the last 20 years that many people aren't familiar with. I think he's like the second or third largest outside shareholder of Amazon, actually. They all believe, and they were all investors in Desktop Metal's pipe. So when Desktop Metal came public last year via SPAC, they did a $275 million pipe, and all the people I just mentioned were part of that pipe. So they're all big investors right now, anchor investors in Desktop Metal. And ARK Investments and Cathie Wood have put out numbers before, as part of their big ideas presentations, that they think 3D printing is going to be a $146 billion industry by 2030. And I was already bullish on Desktop Metal when I first started doing my due diligence on them a couple months ago, because the stock ripped up into like the 30s or 40s earlier this year, pulled all the way back into the low teens. I did my write up on Desktop Metal when the stock was about 14. It then kept pulling back down to like 12, and now it's kind of settling into that $13 area. But I literally just added to my position yesterday and again this morning. I don't expect Desktop Metal to do anything phenomenal over the next 2 or 3 months. This is really going to be a 3-year, 5-year, 10-year story as additive manufacturing goes mainstream with all these big manufacturers. But what they're doing in metals is amazing enough by itself. I mean, literally steel, carbon fiber, all sorts of other composites. But now they've actually done a couple acquisitions to get them into polymers and elastomers. So polymers is like plastics, elastomers is like rubbers. So now they got FDA this new material that they created called Flexera, which they're going to use for dentures. So now they're getting into the dental community, and they said that's another $3 or $4 billion opportunity every year where they can actually 3D print dentures for people. And then maybe the coolest thing they've actually announced recently is a new product called Forust, Forust, and that is 3D printing of wood using sawdust. So they are literally recycling sawdust, combining it with resin, and 3D printing wood parts with any grain that you want. Like, it's the coolest freaking thing I've ever seen, probably. So, I mean, Desktop Metal is just building the foundation for what's going to be a 50, 80, $100 billion company by the end of this decade. At least that's what I believe.
Yeah, that sounds awesome what they are doing. But do you see like any risks, like any competitors in the 3D printing? Because I've seen like many companies right now trying to get into this space.
Yeah. I mean, there's risks with every company. There's competitors for every company. I mean, no one ever is going to have a clear road to success. But I mean, Desktop Metal, from all the research I've done, they have the highest quality, fastest printing machines, the best materials. And I mean, the management team is as high quality as it gets. There's like 7 founders. I think 3 or 4 of them are like MIT professors and research scientists. So really, really strong team. They have a massive IP portfolio. I believe it's almost 100 patents issued, and I think another 100 that have been filed. So, but I mean, this doesn't have to be a winner take all market. I mean, there are some markets out there where, the opportunity is not big enough to have 3 or 4 big winners. 3D printing is big enough to have, multiple big winners. I mean, if this is a $146 billion industry, and that's revenues. So when people talk about total addressable market, they're talking the revenue potential of that addressable market, not the market caps of the companies competing in that market. So if Kathy Wood and Chamath and all those other people are saying that this market could be $146 billion by the end of this decade, that is revenues. So that's revenues split up amongst the winners. And that's why, in my financial models, my 5 and 10-year financial models that I do for companies, but especially Desktop Metal, because I think this is one that you really have to look out a little bit further on. I think they can get to $10 billion in revenues by 2030. And if they can do that, then you're talking a 70, 80, $90 billion company. So yeah, I mean, this is not winner take all. There are many other companies out there. There's 2 3D printing companies that are coming public right now. There's Shapeways, and there's another one that I can't even think of. But yeah, there's a lot of competition out there, but that's all right. There's global manufacturing, and this is not a number that I've made up. This is a number that Rick, the CEO of Desktop Metal, has said, and other people have said it. Global manufacturing is a $12 trillion annual industry. So even if 3D printing gets to 146 billion, it's still just a small percentage of the overall global manufacturing industry. And then Desktop Metal will have what I think might be a 6, 7, 8% market share of, the 3D printing industry. So
this total addressable market includes the dentures that you mentioned, the material manufacturing, and the machine manufacturing?
I think so. To be honest, when Art said 100 dentures and 3D printed wood is kind of brand new. So I don't think Art probably even included that stuff when they did their $146 billion TAM. But I don't think anyone really knows what the true market potential of those 2 new products are. I mean, in many ways, Desktop Metal is now creating these new niches or categories that no one else is even competing in yet. But I don't know if that adds 5 billion to the TAM or 10 billion or something less.
Okay, that's great. Do you have like any other?
That's a lot.
Yeah, we went like over the 3 and then another 2, 3.
Yeah, I mean, I figured I would just hit a couple more since I'm always talking about them on Twitter. It's easier for me to provide some context on audio versus doing Twitter threads where you're limited by space. No, I think that's probably it. I'm trying to think. I'm just going through looking at my portfolio right now, see if I want to talk about any other companies. I know people ask me a lot about TransMedics. I am back in TransMedics. I got back in about 2 weeks ago at 22. I actually added a couple days ago at I think 23. So 23 is actually my cost basis right now on TransMedics. We should be getting the FDA decision on OCS Heart for DBD at some point in the next 4 to 6 weeks. That's at least my thought. I don't think there's a lot of downside for TransMedics. I mean, there would be if the FDA decision comes back and they don't get approval, then I think TransMedics could have another 25 to 30% downside. But if they do get FDA approval, depending on the restrictions or the use of the OCS machines based on distance, I think the stock could move anywhere from 15 to 30% higher. So I feel pretty good being back in the stock with the cost basis in the low 20s. OCS Heart for DBD is what we're dealing with now, and then later this year or early 22, they'll be back in front of the panel for OCS Heart for liver, and then probably 6 months after that, they'll be back in front of the panel for OCS Heart for DCD, which is donation after circulatory death, which is actually probably 3 or 4 times bigger than OCS for DBD. So, that's where the market for potential organs or transplants gets much, much bigger, once we get into liver and once we get into OCS heart for DCD. So, it's been a rocky road this year for TransMedics, once again, another roller coaster stock. But I think if you can be patient and look out 2 or 3 years, I think TransMedics will be a good stock to hold. You still there?
Can you hear me?
Yeah, you're on mute. Yep.
Oh, okay, yeah. Do you have like any companies on your watch list maybe you want to talk about? Like, or maybe in general about the market? Like, what do you see for like what companies do you have your eyes on? Or
I have a bunch of stocks in my watch list. I have 6 or 7 different watch lists on my computer, broken up by market caps. And then I have a watch list just for SPACs. There's a lot of SPACs right now that are, trading right around $10 that I think are going to be great stocks over the next 2 or 3 years, but they just, this is a tough time for them. Once these SPACs get back down to $10, I just think they get stuck there. There's just no buyers ready to come in and move that stock higher, because there's just too much like arbitrage going on and shorting, and I don't even know all the games that are getting played. But I think a lot of investors have just kind of tuned out SPACs until they get through the mergers, they get through the vote, they de-SPAC, and they start trading under their own ticker. And then I think then I think they have to pull back. In some cases, they have to pull back 10, 15, 20% after they de-SPAC before the big buyers start to come in. So, you've seen that on a few different stocks recently, from Clover to View to Blade. They all dropped 20, 30% after they de-SPACed, and then you start to see the buyers come in and push them higher. So, there's a bunch that I'm watching that are right around $10 that I think are going to be, really great investments long term, but I just don't feel compelled to rush in and buy them right now until they de-SPAC. I'm just trying to think what else. No,
I have like 2 questions like from people. One says to ask you about LATS or TSIA ticker symbol, and the other one was about ticker symbol AEYE. I'm not sure what these companies are.
Yeah, so AudioEye is the second. What was the first one? LATS?
LATS, LATCH, and TSIA ticker symbol.
I don't know. I'm not sure. I'm not even sure what you're. I can't. I'm not following.
Yes, I'm not sure what this company is.
Yeah. So audio. I thought you said. I'm not sure if you're talking Lots. Lots is like a online used car dealer that's getting crushed today. I don't follow the company, so I'm not really sure. AudioEye, I do have a position. It's like a 1.5% position in my portfolio. This is a company that's helping. So they're helping small businesses and enterprises provide better accessibility on their websites, or be compliant in terms of accessibility. So they build software that helps IT departments identify any problems with their website, where people that had any disabilities or were colorblind or any other issues like that wouldn't be able to access their website. So AudioEye provides the software to diagnose any problems and then and fix them. So there's a couple other companies that do what AudioEye does, but I think they kind of have this market to themselves right now. They're growing at 50 or 60% a year. I think they're on track to grow about 55% this year. And if I remember correctly, the stock is trading now at, I believe, single digits, under 10 times sales. And I think gross margins are back over 70% now, like 72 to 74%. So it's kind of a small software company that no one's very familiar with. I did a write-up on them about a month and a half ago. So I'm still bullish on what they're doing. It's not an exciting company. Like, I can't get as excited and passionate about AudioEye as I do about, Upstart or Celsius or DermTech or one of these other ones. But I think if you're looking for a software company at a very, very reasonable valuation with a very, very large TAM, if you think about how many websites are out there right now, and there's white papers and there's data to show that when your website is optimized for accessibility, you're opening up your website to a larger audience of people. So in many ways, that whatever they charge a month, $50. I mean, it depends, I think, on the size of the website, but in some cases, it pays for itself if you have more people able to access your website, purchase products or whatever it might be. So.
Okay, I got the question about, they say it's a SPAC, the TSIA. I'm not sure if you're familiar with it. Name of company, LATS.
Yeah. Oh, yeah. So I know that one. Yeah. I mean, unfortunately, that's another one of these companies that got off to a pretty hot start when the deal was announced. And then it's just trended back lower to that $10 price. And now it feels like it's going to be stuck around $10 until they de-SPAC. So that's one of the stocks that's on my watch list that I definitely see myself owning in the near future. Once they de-SPAC and then they trade under their ticker for, their own ticker for a couple of weeks, that's the kind of stock that or SPAC that I could see myself getting back into. Another one would be SSPK, which is going to be Weed Maps. That's trading in the mid-teens right now. That's a stock that I see myself getting back into after they de-SPAC. Another one is ACTC, which is going to be Proterra. That one's traded decent. That's still in the mid-teens. That's one that I'm looking at closely. Although I also own LEV, which is Line Electric, so I'm not sure that I really need both, but we'll see. Other ones that I'm watching, Stick, which is going to be BarkBox, Fuse, which is going to be Money Lion, SBG, which is going to be Owlet, and then where is it? I just want to make sure I get the ticker symbol right. I think it's GHVI. GHVI, which is going to be Matterport. And that one's, same thing, mid-teens. So now the ones that are in the mid-teens already before they de-SPAC, I don't think those are as inclined to drop 20, 30% after they de-SPAC. The ones that are trading at $10 right now are stuck at 10 because that's where you have the redemption price. Once they de-SPAC and that guaranteed $10 redemption goes away, it's like someone pulling out, like you don't have a floor. It's like someone, you're standing on a rug and someone pulls the rug away. That's why I think a lot of them are going to have to drop 10, 15, 20% before the buyers come in. But I think the ones that are already trading in the mid to high teens should trade much better after they de-SPAC.
Great. And another question I got was for the company SELB, ticker symbol. The company is Selecta Biosciences.
Oh,
Not
God,
sure if you are familiar.
I don't follow it. I don't think I've ever even heard of it before.
Yeah, I just Googled it and it's like market cap 460 million. It's a company.
I own some stocks with smaller market caps. That's not one that I follow. Yeah. I don't really do anything in biotech.
Yeah, so that's all I got. I checked my DMs and some comments under the post. I think that's all I've got for now.
Okay.
I got another one, says your view on Ford's ability to challenge Tesla for market share.
I have no idea.
Yeah.
I mean, I think we've all seen, we all saw the new electric F-150, which looked pretty cool. Ford has already said that they're probably going to produce 1.1 million less cars this year because of the chip shortage. I have no idea what Tesla's number is going to look like when they roll out the Cybertruck. I'm still surprised that they're doing the Cybertruck and not a more traditional looking pickup truck. So I have no idea. I mean, I don't own Tesla. I don't own Ford. I like the EV space, but I also think it's getting very, very competitive. And just traditionally, the auto space doesn't really have the best, history of margins and profitability and return on
cars
capital.
And airlines, I think, are probably one of the worst too.
Oh, yeah. Oh, easily. So, I mean, I think, Ford and GM are both compelling. They both make great cars. I think valuations are fair, but, these companies are going to beat each other up in the EV space for the next, 5, 10, 15, 20 years. I'm completely out of EVs. Well, I own Line Electric, but that's a little bit different. But I even sold my Neo the other day. Neo has a lot of competition in Asia. Tesla has a lot of competition everywhere. I just don't know. I don't know which one to pick. I couldn't tell you which of those companies is going to be the best performer over the next year. So I'm just kind of staying away from all of them.
Okay, and another question about your view on PaySafe, ticker symbol PSFE, if you're familiar.
I don't know it well enough, so no
Okay.
comment or opinion. Tomorrow, I'm actually interviewing Betsy Cohen. She is a longtime financial services entrepreneur, and she's also taken. I think she's behind 7 or 8 SPACs, and I believe they've announced 3 deals thus far for eToro, Payoneer, and Perella Weinberg. So I'll be talking to her tomorrow. I think it's 12 o'clock Eastern time, and I'll ask her about those 3 SPACs. So I'll be doing some due diligence on them tonight. I think Payoneer and PaySafe are similar, but I could be wrong. I mean, they're both fintechs, obviously, but I don't know exactly what PaySafe does versus some of the others. I have an idea, but to be honest, I haven't done enough DD on the company to have an opinion.
Okay, great. And then I got another question, but it's not about the companies. Like, what do you feel about rising interest rates for your stock portfolio? I'm not sure if you want to answer that.
So, I mean, I think inflation. So, okay, this is my opinion, and I'm not a macro guy. So, some of this is just, I don't know. This is just how I'm feeling. I think inflation is over exaggerated. I'm sort of on the Kathy Wood side of this, or even the Fed's side of this when they say it's transitory. We are comparing current numbers to numbers last year, which were artificially low because of the pandemic and lockdowns and everything else. So, we had deflation last year, which is going to make any numbers this year look bad. But I don't think it's going to stay that way for much longer. As commodity prices start to come back down, used car prices, housing prices. I don't think. I mean, we are definitely in a bubble in some things. Lumber up 300% in a year. That's ridiculous. That's a bubble. That's not sustainable. Copper and some other commodities probably too. I don't know how much they pull back, but so I just, if you look at the 10-year Treasury, I mean, the 10-year Treasury went from a few months ago in the 0.5, 50 basis points range, and then a month and a half, 2 months later, it was up in the 160 basis points or 1.65 range. And that was one of the reasons why growth stocks got hammered. I think there's other reasons. I mean, they got overheated, the shorts. I mean, just lots of reasons. Retail started to disappear, or retail went to crypto. And when I say retail, I guess I'm talking about the millennials and the Robin Hooders. I'm just not overly worried about inflation. Now, if the 10-year starts to, cruise back up towards 165 again, 175, then I'd probably become a little more concerned. I mean, I would assume that my stock would sell off a little bit as that was happening. I would probably buy some put options for protection. So, that I regret not having a little bit more protection or hedging on my portfolio when the growth sell-off started in February. I'm not going to make that mistake again. I'm back in the green, pretty deep in the green, not just today, but for the year overall. And I don't want to lose these gains again. So if it means that I have to spend money on put options, which is basically insuring your portfolio or protecting the downside, then I'll do it. That would obviously eat into my gains or eat into the upside. But I think, given where we are right now and how much money I've already made this year, I'm fine, buying some insurance. You want to buy insurance before your house burns down, not after. So.
Yep. And I have another question for Upstart. I think you mentioned about the lockup period for 12 million shares. I think when you talked about Upstart.
I don't know. I don't have the
Briefly.
exact number in front of me.
Yeah, like someone asked me, like there's a lockup expiring for about 12 million shares. Given the price acquired is $12, many insiders might sell, given
Yeah,
it's
I
100
already
times
answered that.
return.
I answered it.
Okay, yeah,
I can't predict who's going to sell. You can't predict. That person can't
yeah.
predict. I have no idea who's going to sell their shares. And like I said, I think there's institutional buyers that are waiting to pounce on the stock if it pulls back after expiration. So if people want to make a big freaking deal about the lockup and, try to build a bear case, go for it. I'm not going to buy into it. I got better things to do.
Yep. And again, for Upstart, do you think they will behave like a bank in a higher interest rate environment and increase their margins?
I mean, interest rates should not really impact them, because they're providing software, they're generating fees, they're not taking any credit risk. So, I mean, to the extent that banks continue making personal loans and auto loans, which I see a good likelihood of that happening, given how strong the economy is right now and how strong their balance sheets are. As long as banks are giving out loans, then they're paying those fees to Upstart to use their AI models. So, there's no like inflation risk or interest rate risk with Upstart, because I don't know if that's the question they're trying to ask or not.
Yeah, I'm not sure. Like it was in a comment under my post.
Okay.
Let me
Okay.
see. Yeah, I think
That's
that's
it
all
for
we
me.
have for now. Yeah.
Yeah, I gotta go. We got an
Yeah.
hour left in the day, and I got a few things I got to do.
Yeah, sure. Thanks for being here. Like I think you covered like so many things. We have enough material for 3 Twitter Spaces. So thank you very much for accepting the invitation, and thank you everyone